What happens to bonds when inflation rises for teens? Imagine saving your allowance to buy a new game or gadget. Now think about how rising prices in the store make your money buy less. That's similar to what happens to bonds when inflation goes up. Bonds are like loans you give to companies or governments. They promise to pay you back with interest. When you buy a bond, you agree to get a fixed amount of interest each year, called the coupon rate. For example, a bond might pay 5% interest yearly. But here's the catch. If inflation increases, the money you get from the bond doesn't stretch as far. If inflation is 6% but your bond pays only 5%, your money's buying power actually shrinks. That means you're losing some of the value of your earnings. When inflation rises, bond prices tend to fall. Why? Because new bonds will likely offer higher interest rates to keep up with inflation. Investors won't want to pay full price for older bonds that pay less. So the prices of those older bonds drop. When bond prices go down, the yield or the return you get from the bond actually goes up. This is because the fixed interest payments now seem more attractive compared to the lower price you pay for the bond. Central banks like the Federal Reserve often raise interest rates to fight inflation. When they do this, new bonds pay higher interest rates, making older bonds with lower rates less appealing. This causes their prices to fall even more. Longer-term bonds are more affected by inflation because they take longer to mature. If you buy a bond that matures in 10 or 20 years, inflation can eat away at its value more than a shorter-term bond. For example, if you have a bond that pays $50 a year on a $1,000 investment, rising inflation means that $50 won't buy as much candy or games as before. If new bonds start paying $60 a year because of inflation, your bond isn't as valuable anymore. If you want to protect yourself from inflation, you can buy special bonds called Treasury Inflation Protected Securities. These bonds adjust their payments based on inflation, so your earnings stay more stable. Another idea is to buy bonds with different maturity dates, called a bond ladder. This helps spread out the risk from changing interest rates and inflation. To sum up, when inflation rises, the real value of the fixed payments from bonds drops, and bond prices tend to fall, especially for bonds with lower interest rates or longer times to maturity. This means bonds can lose value when inflation is high, so it's important to understand this if you're thinking about investing in bonds someday.